Welcome back, my friends. The news today is that WeWork has finally emerged from bankruptcy, and it has announced John Santora as new CEO. WeWork emerged from bankruptcy on Tuesday after renegotiating 190 leases and exiting 170 locations. Commercial real estate veteran John Santora will replace David Tolley as CEO. Tolley led the company through a tumultuous period of financial restructuring. But before we get into all of that, I would like to thank everyone who views my videos. If you would like to support the channel, please see the link to buy me a coffee in the video description below. And please hit the like button and leave me a comment below. I would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. WeWork, the shared office space company once valued at $47 billion, emerged from bankruptcy on Tuesday and named Cushman & Wakefield executive John Santora as its new CEO. WeWork filed for Chapter 11 bankruptcy protection in November, with total liabilities of $1865 billion against assets of $1506 billion. The COVID-19 pandemic, which led to a surge in vacancies, coupled with an economic slump and steep downturn in tech valuations, contributed to WeWork's troubles. Santora becomes WeWork's fourth permanent CEO in 5 years after the company's failed initial public offering in 2019 and subsequent restructuring. He replaces David Tolley, who began service as interim CEO in May 2023 before assuming the permanent role in October. The announcement comes more than a week after WeWork's target exit date of May 31st. WeWork also announced a new board, including Anant Yardi, CEO of property management software company Yardi Systems. During Tolley's brief tenure, WeWork entered bankruptcy protection. The company has since renegotiated more than 190 leases and exited more than 170 unprofitable locations, according to a company release. Santora previously served as Cushman & Wakefield's tri-state chairman and leaves the commercial real estate firm after 40 years. The downsizing of WeWork's real estate portfolio reduced annual rent and tenancy expenses by more than $800 million, and the company also secured $400 million of additional equity capital. WeWork said last week that its portfolio now includes about 45 million square feet in 600 locations across 37 countries. WeWork was founded in 2010 by Adam Neumann and Miguel McKelvey. Neumann led the company through years of historic growth and massive financing rounds. He was ousted in 2019 soon after WeWork's IPO prospectus was released. The company eventually went public in 2021 through a special purpose acquisition company, SPAC, before equity holders were wiped out 2 years later. The company quickly evolved into a global flexible space provider, offering physical and virtual shared spaces for entrepreneurs and businesses. Their vision was to create environments where people could come together and do their best work. Since then, WeWork has raised an impressive $969 million in funding and achieved a valuation of $10 billion. WeWork, once valued at a staggering $47 billion in 2019, filed for bankruptcy in 2023. The company's stock plummeted more than 98% since the beginning of that year, and its valuation dropped to a mere $45 million. Here's what led to WeWork's downfall. 1. Business model. WeWork acted as a middleman, leasing and refurbishing office spaces, then renting them out at marked-up rates to companies and freelancers. 1. Their lavish spaces with amenities like free kombucha and beer attracted tenants. 2. Debt burden to amass its large portfolio of leased office space. WeWork took on tens of billions of dollars in debt. 2. Japanese venture firm SoftBank alone invested $17 billion in the company. 2. However, demand for shared office space never matched their acquisitions. 3. Insufficient demand. WeWork's debt-fueled spending collided with insufficient demand from businesses and freelancers. 3. The COVID-19 pandemic, which forced remote work, exacerbated the situation. Despite its meteoric rise, WeWork's aggressive expansion and financial missteps ultimately led to its bankruptcy. Adam Neumann, the co-founder and former CEO of WeWork, faced significant criticism during his tenure. Here are some reasons why he was considered a lousy CEO. 1. Vision versus reality. Neumann had an ambitious vision for WeWork as a global community-driven workspace provider. However, his execution often fell short. 1. The company's rapid expansion and aggressive spending outpaced actual demand, leading to financial instability. 2. Corporate governance. Neumann's leadership style was unconventional, and he maintained significant control over WeWork even after going public. 2. This lack of transparency and corporate governance raised concerns among investors and stakeholders. 3. Financial mismanagement. WeWork's financials were murky with large debts and losses. 3. Newman's personal dealings with the company, including leasing properties he owned back to WeWork, raised eyebrows and contributed to investor skepticism. 4. Culture and behavior. Newman fostered a party-like culture at WeWork, which clashed with the company's professional image. 4. Reports of excessive spending, extravagant parties, and erratic behavior undermined investor confidence. 5. IPO debacle. WeWork's failed attempt at an initial public offering, IPO in 2019, exposed Newman's mismanagement. 5. The IPO prospectus revealed unsustainable financials, leading to a dramatic decline in valuation and investor trust. Newman's leadership decisions, financial missteps, and unconventional behavior ultimately contributed to WeWork's downfall. WeWork emerged from bankruptcy after a challenging restructuring process. Here are the key outcomes. 1. Debt reduction. WeWork successfully eliminated a staggering $4 billion in debt through its Chapter 11 bankruptcy plan. 2. New leadership. The company appointed John Santora, a commercial real estate industry veteran, as its new CEO. 2. Santora most recently served as tri-state chairman at global real estate services firm Cushman & Wakefield. 3. Equity changes. Existing equity shares were canceled, but top shareholder SoftBank retained a minority stake due to loans it provided to WeWork. 3. The post-bankruptcy equity is estimated to be worth approximately $750 million, a significant drop from the $47 billion valuation in 2019. WeWork's journey highlights the challenges faced by high-growth startups and the importance of sustainable financial practices. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. And before we end, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions, doctors, including any type of specialty, nurses, and that includes all grades of nurses, lawyers regardless of area of legal focus, teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Thank you for watching.